Hey everyone, welcome back. We're diving into a topic today that's super important for the Level 2 CFA exam, and honestly for any investor who wants to really understand how to value companies.
Yeah, you got it. It's free cash flow.
Oh man, free cash flow. I know a lot of candidates get a little intimidated by this concept.
I get it. It can seem complicated at first, but trust me, once you wrap your head around it, it's such a powerful tool for analyzing businesses.
So like what makes it so powerful? Why is free cash flow such a big deal when we're talking about valuation?
Well, think about it this way. Like when you're buying a house, you don't just look at the sticker price, right? You dig deeper. You want to see how much it actually costs to maintain the house. You think about property taxes, potential repairs, all that stuff.
You got to look beyond the surface to figure out the true cost of owning that house.
Exactly. And free cash flow is kind of like that. For companies, it helps us look beyond just the earnings or the dividends and see how much cash the business is actually generating and how much is available to, pay down debt, reinvest, or distribute to shareholders.
Okay, that makes sense. It's like getting a clearer picture of the financial health of the company.
Yeah. It's about understanding the cash that's actually available, not just what's on the books.
So to start off, let's talk about the two main types of free cash flow. We have FCFF free cash flow to the firm, and then we have FCF.
Perfect analogy.
So how do we decide which one to use? Is one better than the other?
It really depends on what you're trying to analyze. If you're looking at a company with a stable capital structure and you're mainly interested in what the equity is worth, FCFE can be a really straightforward approach.
But what about companies that have a lot of debt, or maybe even those with negative FCFE?
That's when FCFF can be really helpful. You can value the entire company first, regardless of its capital structure, and then subtract the value of debt to get to the value of the equity.
Ah, so it's like a two-step approach for those trickier situations.
Exactly. It gives you more flexibility.
Okay, that makes sense. So now let's get into the nitty-gritty. How do we actually calculate these free cash flow numbers? Where do we even begin?
Well, there are actually several starting points for calculating both FCFF and FCFE, and each one requires some specific adjustments.
Okay, that sounds kind of confusing. Can we break that down a bit?
Of course. So you can start with net income, which I'm sure a lot of you are familiar with from your level 1 studies.
Right, net income. That's the bottom line of the income statement.
Exactly. To get to FCFF from net income, you need to add back certain non-cash charges, like depreciation.
Okay, so depreciation, that's a non-cash expense because it reflects the decline in value of an asset over time, but no actual cash is leaving the company, right?
Right. And then you also need to adjust for the after-tax interest expense.
Interest expense. Yeah. But why would we add that back? Isn't that a real cash outflow?
It is, but remember, FCFF is about the total cash flow generated by the business available to both debt and equity holders. So we add back the after-tax interest expense to capture the portion of cash flow that went to debt holders.
Gotcha. So we're putting those debt holders back in the picture.
Precisely.
What else do we need to adjust for when we're starting with net income?
Well, we also need to account for investments the company makes.
Like what kind of investments?
Investments in fixed capital like property, plant, and equipment, as well as investments in working capital, which includes things like changes in inventory and accounts receivable.
So these are cash outflows that we subtract from our starting point.
Exactly, because they represent cash that's being used to maintain or grow the business.
Okay, so starting with net income, it seems like there are quite a few adjustments we need to make to get to FCFF.
There are, but the logic behind each adjustment is pretty straightforward once you get the hang of it.
You're right. It's all about understanding those drivers of cash flow.
Absolutely. Now, we also mentioned that you can start with cash flow from operations to get to FCFF.
Right. Cash flow from operations, that's one of the three main sections of this statement of cash flows, right?
Yeah. And it can actually be a more convenient starting point because it already incorporates a lot of those non-cash adjustments we make when we start with net income.
So it's like a shortcut.
It can be. To get to FCFF from cash flow from operations, you just need to add back the after-tax interest expense and subtract the net investment in fixed capital.
Okay, less work. I like it. Now, what about EBIT and EBITDA? Can we use those to calculate free cash flow?
Yeah, they can also be useful starting points, particularly if you're dealing with companies that have different capital structures or tax rates.
So like a company with a lot of debt or a company operating in a country with high corporate taxes.
Exactly. For example, with EBIT, you'd multiply it by 1 minus the tax rate to get to after-tax operating income, then add back depreciation and subtract net investments in fixed and working capital to arrive at FCFF.
Okay, so different starting points, but we're ultimately trying to get to that same destination, free cash flow.
Exactly. It's like choosing different routes to get to the same place.
I like that analogy. Now, I'm a learn by doing kind of person. Can we walk through a specific example to see how this actually works in practice?
Sure. Let's say we're looking at Kane Distribution, a company that well distributes industrial goods. We have their income statement and their statement of cash flows in front of us. Let's assume their net income is $100 million. Depreciation is $20 million, after-tax interest expense is $10 million, net investments in fixed capital is $30 million, and investments in working capital is $5 million.
Okay, so we've got our numbers. How do we actually calculate FCFF using these figures?
Since we're starting with net income, we first add back depreciation and after-tax interest expense. So that's $100 million plus $20 million plus $10 million, which gives us $130 million.
Okay, $130 million, and then what?
From that, we subtract net investment in fixed capital and working capital. So $130 million minus $30 million minus $5 million gives us $95 million. So Kane Distribution's FCFF is $95 million.
Okay, I see how it all comes together. It's all about making the right adjustments based on our starting point.
That's right.
Now, before we move on, are there any common mistakes or things we should be extra careful about when we're calculating free cash flow? Any red flags that could trip us up?
Oh, yeah, definitely. One common mistake is double counting or omitting certain cash flows. For example, if you start with net income and add back the entire depreciation expense, but then you also subtract capital expenditures that include depreciation, well, you've essentially counted depreciation twice.
Ouch. That's a sneaky one.
Right. So you got to be really careful and understand what's included in each number you're working with. And then another thing to watch out for is companies trying to manipulate their free cash flow figures to make themselves look more attractive to investors.
Oh, okay. How do that?
Well, there are all sorts of tricks they can use. For example, they might aggressively extend payment terms to suppliers to boost their cash flow from operations in the short term, or they might delay necessary capital expenditures to make their free cash flow look higher than it really is.
So it's like they're trying to paint a rosier picture than what's actually going on.
Sometimes, yeah. That's why it's so important to not just look at the numbers in isolation, but to really understand the company's underlying business and their accounting practices.
Right. It's all about doing your due diligence. So we've tackled the calculation part, but now comes the really fun part, forecasting free cash flow into the future. Do we need a crystal ball for that?
Well, a crystal ball would be nice, but unfortunately we have to rely on our analytical skills and a bit of educated guesswork.
So what are some of the key factors we need to consider when we're trying to predict a company's free cash flow years down the road?
Well, we got to think about sales growth, profit margins, investment needs, both for fixed capital and working capital, and how they're financing those investments.
Okay, so a lot of moving parts. Let's break that down. Starting with sales growth, how do we even begin to predict that?
We can look at historical trends, industry growth rates, the company's own projections, and even macroeconomic factors. But we always want to be realistic. Those super high growth rates are rarely sustainable in the long run.
Right. Companies can't defy gravity forever.
Exactly. And then we need to think about profit margins. If a company's profit margins are declining, even if their sales are growing, their free cash flow might not be as impressive as it seems.
So we got to factor in competition, pricing power, cost management, all those things that impact a company's profitability.
Absolutely. And then there's the investment piece. Companies need to spend money to make money, so we need to forecast their capital expenditures based on their growth plans and the expected useful life of their assets.
Right, so we need to think about how much they're investing in property, plant, and equipment, all that good stuff.
Yep. And we also need to consider their working capital needs. As a company grows, it typically needs to invest more in working capital to support that growth, like holding more inventory or extending more credit to customers.
Okay, so investments can be a bit of a double-edged sword. They're essential for growth, but they also eat into free cash flow in the short term.
Exactly. It's a delicate balance.
Now, finally, how does debt financing come into play when we're forecasting free cash flow?
Well, debt financing can affect our projections in a couple of ways. First, the interest expense on debt reduces net income, which in turn reduces free cash flow.
Right, because those interest payments are real cash outflows.
Exactly. And second, taking on new debt can actually boost free cash flow to equity in the short term. But we need to remember that those borrowings eventually need to be repaid.
So it's a trade-off between short-term gains and long-term obligations.
That's it. It's about managing that balance between using debt strategically to fuel growth and making sure the company can handle those debt payments down the road.
Okay, that makes sense. Now, can we walk through an example of how we'd actually forecast free cash flow for a specific company?
Of course. Let's go back to Pitts Corporation, that manufacturing company we mentioned earlier. We can start by gathering all their historical data, their sales growth, EBIT margins, capital expenditures, working capital changes, all that good stuff.
Okay, so we're digging into their financial statements, looking for patterns and trends.
Exactly. And then we use that historical information as a starting point and make some educated assumptions about how those factors might evolve in the future, taking into account their industry, their competitive landscape, their strategic plans, all those qualitative factors.
Right, so we're building a narrative around the number.
Exactly. But what if our assumptions are wrong? I mean, predicting the future is notoriously difficult.
Oh yeah, you never know what's going to happen.
That's why sensitivity analysis is so important. It allows us to test how changes in key variables like sales growth, profit margins, or the discount rate would affect our valuation.
Right, so we're not just relying on one set of numbers. We're running different scenarios to see how sensitive our valuation is to those assumptions.
Exactly. It helps us understand the range of possible outcomes and where the biggest risks and opportunities might lie.
I like that. Now, we've talked about calculating and forecasting free cash flow, but how do we actually use these numbers to value a company? That's the ultimate goal, right?
Absolutely. That's where free cash flow models come in. They're the tools we use to turn those cash flow projections into a concrete valuation.
Okay, so these models help us figure out what a company's actually worth based on its ability to generate cash.
Exactly. And there are different models for different situations, but they all share that same basic principle, discounting future free cash flows back to their present value, just like we do with bonds or other investments.
Got it. So we're bringing those future cash flows back to today's dollars to see what they're worth to us right now.
Precisely. And that brings us to our next topic, the different types of free cash flow models, which we'll dive into in more detail after a quick break.
Sounds good. I'm ready to put on my valuation hat.
All right, so we've laid the groundwork for understanding free cash flow. Now let's get into the exciting world of free cash flow models, where we actually use these numbers to try to figure out what a company is worth.
I'm with you. Let's jump right in.
Okay, cool. So where do we start?
Well, we can start with the simplest model, the single-stage model, also known as the constant growth model.
The constant growth model. Okay, that sounds manageable.
Yeah, it's pretty straightforward. The basic idea is that we're assuming the company's free cash flow will grow at a constant rate forever.
Forever? Really? Like, are there any companies out there that actually grow at a constant rate forever?
Well, you're right. It is a simplification of reality. Very few companies actually grow at a constant rate forever.
Right.
But it can be a reasonable approximation for certain types of companies, stable, mature companies that are in industries with pretty predictable growth patterns. Okay, so like what kind of companies are we talking about?
Well, think of companies like utilities or consumer staples. They might not be the most exciting high-growth businesses, but they tend to generate pretty consistent cash flows year after year.
Right, so we're talking about those steady Eddie companies, not the, disrupt everything kind of businesses.
Yeah, exactly. So for those types of companies, the constant growth model can be a useful starting point.
Okay, I'm following you. So how does this single-stage model actually work? Like, what's the formula?
Well, the formula is pretty simple. We take the next year's expected free cash flow and divide it by the difference between the discount rate and the constant growth rate.
Hold on, remind me, what's the discount rate again? I know we talked about it earlier, but it's all starting to blur together.
No worries. So the discount rate is our old friend, the weighted average cost of capital, or WACC as we like to call it.
Yes, WACC. It's all coming back to me now.
It represents the average rate of return that investors require for investing in this particular company, taking into account both the cost of debt and the cost of equity.
All right, so we're basically discounting those future cash flows back to their present value using the company's cost of capital.
Exactly. And the growth rate in the formula is our estimate of how much we expect those cash flows to increase each year into perpetuity.
Okay, so we're taking that expected future growth into account as well.
Yep. Now let's try it out with a real example. Let's say we're looking at Cagiati Enterprises, a Swiss company with a stable capital structure, and we've estimated their FCFE for next year to be 620 million Swiss francs. Their cost of equity is 11.8%, and we expect their FCFE to grow at a constant rate of 5% forever.
Okay, so we've got our key ingredients, next year's FCFE, cost of equity, and constant growth rate. Now what do we do with these numbers?
We plug them into our single-stage model formula. So 620 million divided by 0.118 minus 0.05 gives us a present value of about 10.1 billion Swiss francs.
10.1 billion Swiss francs.
Yeah.
Wow, that's a big number. So that's our estimated value of Cagiati's equity based on our constant growth assumption.
You got it. But it's important to remember that this is just one model, and it relies on some pretty significant assumptions.
Right, like that constant growth rate forever, that seems like a big assumption.
Exactly. So we always want to use multiple valuation approaches and do some sensitivity analysis to get a more complete and well-rounded picture.
For sure. We Level 2 candidates are all about multiple approaches and sensitivity analysis.
Remy, you were...
Now, what about those companies that aren't so stable and predictable?
Yeah.
The ones that are growing really fast or going through major transitions. How do we value those kinds of companies?
That's where multi-stage models come in. They allow us to incorporate different growth phases, which is much more realistic for a lot of companies.
Okay, so like a high growth phase followed by a more stable growth phase.
Exactly. Let's start with the two-stage model. It's the most common multi-stage model, and it assumes that a company will experience a period of higher than normal growth, followed by a period of stable long-term growth.
Okay, I like that. So like a company going through a growth spurt before settling into adulthood.
Perfect analogy. So to value the company, we need to forecast the free cash flow for each stage separately. We can't just assume a constant growth rate throughout the entire life of the company.
Makes sense. So we'd project those high growth cash flows for the first stage, then those stable growth cash flows for the second stage, and then discount all those cash flows back to their present value using the appropriate discount rate for each stage.
You got it. And we'd use different growth rates for each stage reflecting those different growth trajectories. The high growth stage might have a growth rate of 15% or even 20%, while the stable growth stage might be more in line with the overall economy, maybe 3% or 4%, something like that.
Okay, I see the logic there. But how do we decide how long each stage lasts? That seems pretty subjective.
It does involve some judgment.
Hmm.
We need to consider the company's specific situation, its industry, its competitive landscape, and any strategic plans they've announced. It's a bit of an art and a science.
Right, so no magic formula, but we can use our analytical skills and industry knowledge to make educated guesses. Can we try out this two-stage model on one of our example companies?
Sure. Let's look at TechnoShaft, a European tech company that seems to be in that high growth phase right now. Let's assume they have a sales growth rate of 20% for the next 3 years, after which we expect their growth to stabilize at 6% forever.
Okay, so we've got our two stages defined and our growth rates assigned. What's next?
Now we need to translate those sales growth rates into free cash flow projections for each stage. Remember all those factors we talked about earlier, profit margins, capital expenditures, working capital debt financing, all of those come into play here.
Right, we need to consider how those factors might evolve over time as the company moves from that high growth phase to a more mature, stable phase.
Exactly. And once we've got our free cash flow projections for each stage, we discount them back to their present value using TechnoShaft's WACC.
Okay, let's say their WACC is 12.4%.
All right, so we discount those high growth cash flows for the first 3 years at 12.4%. And then we'd use a perpetuity formula to discount those stable growth cash flows from year 4 onwards, also at 12.4%.
Okay, so two different discounting methods. One for that finite high growth period and one for the infinite stable growth period.
That's right. And by adding those two present values together, we get our total estimated value for TechnoShaft.
Okay, I'm following you. So the two-stage model gives us more flexibility to capture those different growth phases. Now, what about those companies that go through even more complex growth patterns? Is there a model for them too?
You bet. That's where the three-stage model comes in. It's essentially an extension of the two-stage model, adding another phase to capture those more intricate growth patterns.
Okay, so instead of just high growth and stable growth, we're adding a transition period in between.
Exactly. So the three-stage model often includes an initial high growth period, followed by a transition period where growth gradually slows down, and then a final stage of stable long-term growth.
Okay, so it's like adding another chapter to the company's life story.
I like that. And the process for using the three-stage model is similar to the two-stage model. We forecast free cash flow for each of the 3 stages, using different growth rates to reflect those different growth trajectories. And then we discount those cash flows back to their present value using the company's WACC.
Got it. So more complexity, but also more accuracy and nuance.
Precisely.
Can we try out the 3-stage model on one of our example companies?
Sure. Let's look at Shimatsu Gekko, a Japanese company that seems to be going through those multiple growth phases right now. Let's say they have an FCFF growth rate of 8.8% for the next 4 years, then a transition period where growth gradually declines over the following 3 years, and then a stable growth rate of 3.2% forever.
Okay, so 3 stages mapped out and growth rates assigned. What do we do now?
Well, we need to translate those growth rates into actual free cash flow projections for each stage. This involves digging into their financials and developing some assumptions about their sales, profit margins, investments, and debt financing for each of those stages.
Right, so we need to consider how those factors might evolve over time as the company moves from high growth to transition to stable growth.
Exactly. And once we have those free cash flow projections for each stage, we discount each stage's cash flows back to their present value using Shimotsky's WACC.
Okay, let's say their WACC is 8.93%.
All right, so we discount the high growth cash flows for the first 4 years at 8.93%. Then we discount the transition period cash flows using those gradually declining growth rates, still using 8.93% as our discount rate. And finally, we use a perpetuity formula to discount those stable growth cash flows from year 8 onwards, also at 8.93%.
Wow, it's like a three-part symphony of discounting each part, reflecting a different phase of the company's growth story.
I like that. And by adding those 3 present values together, we get our total estimated value for Shimotsky.
Okay, these multi-stage models are definitely more complex, but these seem much more realistic than just using a simple constant growth model for every company.
I agree. They allow us to be more nuanced and capture those dynamic growth patterns that many businesses experience. But remember, complexity doesn't always equal accuracy. We still need to be thoughtful about our assumptions and use sensitivity analysis to understand the potential impact of those assumptions.
Right, garbage in, garbage out, as they say.
Yeah.
Now, before we wrap up our discussion of free cash flow models, can we revisit those international considerations we touched on earlier? Valuing companies across borders seems extra tricky, especially when we're dealing with different currencies and accounting standards.
Yeah, international valuation definitely adds another layer of complexity. One of the big challenges is figuring out how to handle different currencies. Do we value the company in its local currency, or do we convert those cash flows and discount rate to our own currency?
Okay, so it's a choice between sticking with the original currency or translating everything into a common currency. What are the pros and cons of each approach?
Well, sticking with the local currency might seem simpler, but then we need to figure out how to incorporate currency risk into our valuation. Those exchange rates can fluctuate quite a bit, which can impact the value of our investment in our own currency.
Right, forecasting currencies is notoriously difficult.
Exactly. And if we choose to translate everything into our own currency, we'll need to make some assumptions about future exchange rates, which, as you pointed out, can be very unpredictable.
Okay, so no easy answers there. It sounds like we need to carefully consider the specific circumstances and our risk tolerance before deciding how to handle those currency conversions. What about those accounting differences? How do those complicate our analysis?
Yeah, different countries have different accounting rules, and these differences can affect how financial information is presented, which can make it difficult to compare companies across borders. Sometimes those accounting differences can even impact the free cash flow figures themselves.
Okay, so it's like adding another layer of due diligence when we're dealing with international companies. We need to be extra careful and make sure we're comparing apples to apples.
Exactly. It's all about understanding those subtle differences and making the necessary adjustments.
Well said. I'm definitely feeling more aware of the complexities of international valuation now. Are there any other international considerations we should be aware of?
Yeah, one more thing. Don't forget about those non-operating assets that might not be captured in our core free cash flow calculations. Things like excess cash, marketable securities, or even real estate holdings can add significant value to a company, especially if they're not directly related to the core operations. This is especially important for international companies as they might have a more diverse portfolio of assets and investments.
Right. Those hidden gems can really boost a company's overall worth. It's like finding extra cash tucked away in a forgotten drawer.
Exactly.
Okay, great. So we've covered a lot of ground on free cash flow models. Anything else we should keep in mind before we move on?
Just remember, these models are powerful tools, but they're not crystal balls. They're only as good as the assumptions we put into them. So we need to be thoughtful, skeptical, and always consider multiple perspectives.
Well said. I'm feeling much more confident in my free cash flow valuation skills now. Let's move on to the final part of our deep dives where we'll talk about how companies actually use their free cash flow. All right, so we've explored like all the different ways to calculate and forecast free cash flow, and we've even tackled those kind of complex valuation models.
Yeah.
But now I'm curious, like, what do companies actually do with all that free cash flow? Well, it's one thing to have cash, but it's another thing to use it wisely, right?
Absolutely. Generating free cash flow is great, but it's really what companies do with that cash that ultimately determines their success. It's like having a healthy income. If you just spend it all on, unnecessary things, you're not going to build any wealth.
Yeah, you're not going to reach your financial goals.
Exactly. You need to have a plan for how you're going to use that money.
So what are some of the most common ways that companies use their free cash flow? Like, what are their options?
Well, they have a few main avenues. They can reinvest that cash back into the business to fuel future growth, Or they can use it to pay down debt to reduce their financial risk. They can also distribute that cash to shareholders through dividends or share buybacks.
Okay, so those are kind of the big three: reinvesting in the business, paying down debt, or giving it back to shareholders.
Yeah, those are the main ones. And then, of course, they can also just hold on to that cash, keep it as a rainy day fund or for future opportunities.
Right, keep some powder dry for unexpected challenges.
Exactly. So it's really a balancing act. Companies need to find that sweet spot between investing for growth, being financially responsible, and rewarding their shareholders.
Makes sense. So as analysts, how can we tell if a company is making smart choices with its free cash flow? Like, what should we be looking for?
That's a great question. One of the most important things is to analyze the statement of cash flows. Really dig into those cash inflows and outflows and see where the money's going. You also want to look at the company's capital allocation policies, their track record with acquisitions, their dividend policy, all those things that give you clues about how they think about using their cash.
Right, so we're looking for a consistent and well-thought-out approach to capital allocation.
Exactly. You want to see that management is making decisions that are aligned with the company's long-term goals and that they're creating value for shareholders.
Now, can we walk through a specific example? I'm always a fan of seeing how these concepts actually play out in the real world.
Of course. Let's go back to Pitts Corporation, that manufacturing company we've been talking about. Yeah. Imagine that Pitts is coming off a strong year with a significant amount of free cash flow.
Okay, so they're flush with cash.
Yeah, they've got options. So what do they do with all that money? Well, they could invest in new equipment to increase their production capacity, or maybe they could expand into a new market, or they could acquire a competitor.
Oh, so they could use that cash to fuel growth.
Absolutely. Or maybe they decide to pay down some of their debt, reduce their interest expense and strengthen their balance sheet.
It's always a good idea, especially if they've got a lot of debt.
Right. Or maybe they decide to give some of that cash back to their shareholders through a dividend increase or a share buyback program.
So they could reward those loyal shareholders.
Exactly. There are so many possibilities.
So many choices. How can we tell if Pitts is making the best choices for their specific situation?
That's where our analytical skills come in. We need to consider their industry, their competitive landscape, their growth opportunities, and their overall financial health. If they're in a rapidly growing industry, they might need to prioritize investments to stay ahead of the curve. But if they're in a more mature industry, they might be better off returning more cash to shareholders.
So it's a judgment call. It depends on the context.
It does. There's no one-size-fits-all approach to capital allocation.
Now, are there any common mistakes or red flags we should be aware of when we're evaluating how companies are using their free cash flow? What are some things that should make us raise an eyebrow?
Yeah, definitely. One common mistake is overpaying for acquisitions. Companies sometimes get caught up in the excitement of growth and they end up overspending on companies that don't actually create value for shareholders.
Right, they get a little too ambitious.
It happens. And another red flag is when companies consistently underinvest in their core business. They try to boost their short-term free cash flow by cutting back on essential investments like maintenance or research and development.
So they're sacrificing long-term growth for short-term gains.
Yeah, and that's usually not a sustainable strategy.
So it's all about balance, finding that middle ground between being too aggressive and too conservative.
I agree. Free cash flow analysis is really about understanding those drivers of cash flow, forecasting those cash flows into the future, and then assessing how effectively the company is using its cash to create value for shareholders. Are they investing wisely? Are they managing their debt prudently? Are they returning cash to shareholders when it makes sense?
Wow, we've covered a lot of ground today. From the nitty-gritty of calculating and forecasting free cash flow to the more strategic considerations of capital allocation, it's been a fantastic deep dive.
I agree. It's been fun.
So to all our fellow Level 2 candidates out there, keep practicing, keep learning, and never underestimate the power of free cash flow analysis. It's a game changer, and it can really help you make better investment decisions.
That's right.
Thanks for joining us today, and happy studying.